So, picture two completely contrasting realities, separated by just a handful of months.
Okay, I'm picturing it.
Right. So in the year 2000, Enron is the undisputed darling of Wall Street. I mean, they have a market cap of over $60 billion.
Which is just massive.
Yeah. And Fortune magazine has just named them America's most innovative company for the 6th year in a row.
6 years, right.
But then, fast forward just a few months to December 2001, that exact same company files for what was, at the time, the largest corporate bankruptcy in U.S. history.
It's just staggering.
Like $74 billion in shareholder value just vaporized, like gone. 4,000 jobs wiped out instantly.
Yeah, it defies logic when you put those two data points side by side. The transition from this untouched juggernaut to just absolute ruins, it happened practically overnight.
Exactly. And that's really our mission for this deep dive today. For you listening, we're not just, recounting a story of corporate greed. We want to untangle how this illusion was actually built.
Right. How did they pull it off?
Right. How did a seemingly boring natural gas company pull off a magic trick that fooled Wall Street, the banks, the media, like everybody?
Well, to understand it, I always tell people to think about a personal finance analogy.
Oh, I like those.
Yeah, so imagine finding out that your wildly successful friend, like the one driving the new sports car, always picking up the tab at dinner, talking about their massive stock portfolio, isn't actually wealthy at all.
Oh, man, like it's all fake.
Exactly. You look a little closer and realize they've just been using like a dozen secret credit cards to pay the minimum balances on a dozen other secret credit cards.
Wow. So the whole lifestyle is just a mirage funded by debt.
Right. And that is essentially what was happening in Houston, Texas, just on a multi-billion-dollar scale.
Yeah.
But to build a mirage that big, you can't just cook the books on a normal pipeline business.
No, of course not. You'd get caught immediately.
Exactly. You have to fundamentally change what your company actually does. The seeds of this entire collapse were planted in Enron's deliberate pivot from a physical, tangible business into a purely financial one.
Right. So let's go back to the start. Kenneth Lay forms Enron in 1985, right? And he basically just merges two incredibly mundane natural gas pipeline companies.
And Houston Natural Gas and InterNorth. Very boring stuff.
Super boring. At that stage, they literally just own physical pipes in the ground. They move gas from point A to point B. It's a stable, predictable, heavily regulated utility business.
You charge a set rate for moving the gas, you make a modest profit, you pay a dividend. Everyone is happy, but nobody's getting rich.
Right. It's not the kind of operation that generates explosive stock growth or gets you on magazine covers.
Definitely not.
Yeah.
But the turning point really arrives in the early 1990s when the U.S. government deregulates the sale of natural gas.
Deregulation. Always a big catalyst.
Oh, totally. Suddenly, prices aren't fixed by the government anymore. They fluctuate based on the open market, just like stocks or bonds. And that's when Jeffrey Skilling enters the picture.
Skilling. I mean, he's such a huge character in all of this.
Huge. He comes in and he realizes that the real money isn't in moving the physical gas through the physical pipes. The real money is in trading the contracts for the gas.
So he transitions them into a trading floor.
Exactly. He transitions Enron from a company that simply supplies energy into a company that acts as a giant financial trading hub. They eventually launched this thing called Enron Online.
Right. Their website.
Yeah, and it becomes a massive platform for trading these energy contracts. They effectively stop being a pipeline operator and become the Wall Street of energy.
And because they were the counterparty to every single trade on that platform, their transaction volume was just astronomical.
Right, and that volume is key because it gave them the cover to implement something called the merchant model for their accounting.
Okay, break that down for me, the merchant model.
Sure. So in a traditional brokerage setup like, think of Goldman Sachs or something, when they broker a trade between a buyer and a seller, they only report their trading fee or their commission as actual revenue.
Okay, that makes sense. That's the normal agent model.
Right. But Enron decided they weren't going to play by those rules. Instead of just reporting their fee, they reported the entire value of the trade as their own revenue.
Wait, so if I'm a real estate agent and I sell your house for $1 million, I might make, what, a 3% commission?
Yeah, pretty standard.
So under normal accounting, my revenue for the year is $30,000. But under this Enron merchant model, I get to claim that entire $1 million house price as my personal income for the year.
Yes, that is exactly what Enron did.
That is insane. How is that even legal?
Well, It was an insanely aggressive interpretation of the rules. But because Enron was legally acting as the counterparty, meaning they were buying the contract from the seller and instantly selling it to the buyer, they argued they were technically taking ownership of the asset, even if it was just for a fraction of a second.
Oh my gosh, just a technicality.
Yeah. But the result was an artificial explosion on their income statements. Between 1996 and 2000, their reported revenue shot up from $13.3 billion to over $100 billion.
100 billion. That's over 750% growth in 4 years.
Right. And you have to remember the context. This was happening right in the middle of the late 90s dot-com boom. Wall Street was completely obsessed with top-line revenue growth.
Oh, totally.
Yeah.
Investors were throwing money at anything showing massive revenue, even if they were bleeding cash.
Exactly. Enron's trick was so effective at making them look like this unstoppable force that it forced their real-world competitors, companies like Duke Energy and Dinergy, to adopt the exact same accounting trick just to keep up.
Just to maintain their Fortune 500 rankings.
Yeah.
Wow. But, I mean, massive top-line revenue doesn't actually mean you're making a profit.
No, it definitely doesn't.
If the revenues were inflated, how did Enron show Wall Street consistent, record-breaking profits? Because you need bottom-line earnings to keep the stock price climbing.
Right. And this is where Skilling brought in his masterpiece, the true engine of the fraud, mark-to-market accounting.
Mark-to-market. I saw this all over the sources.
Yeah. And the shocking part is that he didn't just sneak this past regulators. Enron actually actively lobbied the SEC in 1992 and officially got approval to use mark-to-market accounting for their natural gas futures.
They got official permission.
They did. They managed to convince the SEC that their long-term supply contracts were highly liquid financial derivatives rather than standard delivery contracts.
Okay, so how does mark-to-market actually work in practice?
So under traditional accounting, if you sign a 20-year contract to supply energy to a city, you record the actual costs and the actual revenues year by year, right?
Yeah.
As the energy is delivered.
Makes sense. You get paid, you log the profit.
Right. Mark-to-market completely flips that. The moment Enron signed a long-term contract, they would build a complex mathematical model estimating the total profit they expected to make over the entire 20 years.
Wait!
And then they would book all of that estimated future profit onto their current financial quarter's balance sheet today.
That is wild. I actually found a perfect, glaring example of this in the sources. The Blockbuster video deal.
Oh yeah, the Blockbuster deal is classic.
So listeners, picture this. July 2000, Enron signs a 20-year agreement with Blockbuster to introduce broadband video on demand to U.S. cities.
Which was way ahead of its time, technologically.
Way ahead. They had barely completed a few pilot projects, like the ink is still wet on the contract, but Enron instantly claims $110 million in estimated future profits on their books for that exact quarter.
Incredible.
They literally paid out executive bonuses based on that fake $110 million. And here's the kicker. The deal completely fell apart just a few months later in March 2001.
Right. The tech didn't work. The logistics were a nightmare. Total bust.
Total bust.
Yeah.
But did they take that $110 million off the books?
Of course not. Taking it off the books would mean admitting a massive financial loss to Wall Street, which would tank the stock price. So they simply left the fake profits on the books.
That's the trap. If you claim 20 years of income on day one, what on earth do you show the investors next year? You have no future income left from that project.
Yep. You're on a terrifying accounting hamster wheel.
You have to constantly hunt down bigger and crazier deals just to generate new contracts that you can mark to market.
And that hunger for new deals drove them into markets they literally didn't understand. They were doing highly speculative stuff globally, and a vast number of these deals were failing spectacularly in the real world.
Like the Azurix water project.
Oh, the Argentina deal.
Yes. Enron decides they want to dominate the global water utility business, so they bid over $438 million for the rights to run a major water system in Argentina.
Which was what, roughly twice what anyone else bid?
Exactly. Naturally, they won the contract, but when their executives actually fly down to Argentina to inspect the facilities, they find absolute shambles, the physical infrastructure is failing, and the customer billing records had literally been destroyed.
It was a massive financial disaster, hemorrhaging real cash.
So my question is, where did those actual real-world massive losses go? If they couldn't let those losses touch the official Enron balance sheet, how did they hide them?
Enter Andrew Fastow, Enron's chief financial officer.
The CFO.
Yeah. Fastow engineers this highly complex network of special purpose entities, or SPEs.
Okay, SPEs. What are those exactly?
On paper, an SPE is a totally standard financial tool. It's just a temporary shell company created to isolate financial risk or manage specific assets. Normally, a corporation sets up an SPE and secures it with independent outside equity from a bank or an investor.
Right, like real money.
Yes,
Yes.
real money. But Fastow didn't use independent outside money. The fatal flaw, the absolute center of this fraud, was that Enron was secretly capitalizing these shell companies using its own stock.
Using its own stock to back its own shell company.
Yes.
It's like co-signing a massive bank loan for your notoriously broke cousin. The bank feels secure because they have a guarantor, but your broke cousin is actually just you wearing a fake mustache.
That's hilarious. But yes, exactly. If the loan goes bad, the bank comes after the guarantor, but there's still no actual money there. It's a completely closed loop of imaginary security.
It's all smoke and mirrors. And Fastow built like dozens of these interconnected shell companies.
No, he built a whole empire of them. And the corporate culture was so bizarre, he literally named some of these entities after the velociraptors in Jurassic Park.
You can't make this up.
Raptor Eyes through 5. There was also Chewco, named after Chewbacca, and another one called White Wing.
So unprofessional.
Right. And so when an Enron project like that Argentine water deal went sour, Enron would sell that toxic asset to one of the Raptor companies at an artificially inflated price.
Wow. So Enron gets to book a profit on the fake sale, keeping Wall Street happy. And the Raptor company just absorbs the massive debt, hiding it off Enron's official ledger.
Exactly. But the only thing giving the Raptor companies the financial backing to absorb those billions in debt was the promise of Enron stock.
Ah.
So as long as Enron's stock price kept going up, the shell companies appeared solvent. But the moment the stock price dropped, the underlying value would evaporate.
And all that hidden toxic debt would suddenly boomerang straight back onto Enron's main balance sheet.
Yep. It was an incredibly precarious house of cards. And making it infinitely worse, Fastow was personally managing several of these off-book entities, like one called LJM.
Wait, the CFO was running the shell companies himself.
Yeah, he was negotiating deals on behalf of the shell company against Enron, where he was the sitting CFO. He personally pocketed over $30 million from managing these side deals.
That is a massive, blinding conflict of interest. How did the board allow that?
Well, the Enron board of directors actually held a formal vote to explicitly suspend their own corporate code of ethics just to allow Fastow to do it.
They suspend their own ethics code. Unbelievable.
It really points directly to the toxic corporate culture that Jeffrey Skilling built. I mean, they had digital stock tickers installed in the company elevators so every single employee could watch the price go up in real time.
Just absolute obsession with the stock price.
Yeah. At budget meetings, Skilling would literally look at his division managers and ask, "What earnings do you need to keep our stock price up?" And they would simply work backwards from that target and invent the numbers.
Cash flow didn't matter. The only metric of success was the stock price.
Because everyone's massive bonuses and stock options were entirely dependent on it. They specifically hired former accountants from the Financial Accounting Standards Board, the FASB.
Wait, the people who write the national accounting rules?
Yes. They hired them and paid them massive salaries to comb through the tax code and find every possible exploit, loophole, and gray area.
But, okay, a publicly traded company still has to be audited by an independent firm, right? The whole financial system relies on auditors being the adults in the room, checking the math.
You would think so.
Where was Arthur Andersen in all this? Because they were one of the prestigious Big Five accounting firms in the world.
Arthur Andersen's failure here is just a textbook study in misaligned incentives. In the year 2000, Andersen earned $25 million in audit fees for checking Enron's books.
Okay, that's a lot of money.
But they also earned $27 million in consulting fees from Enron, helping them design the very financial systems they were supposed to be objectively auditing.
Oh, man. So they were making more money giving Enron advice on how to structure the business than they were making verifying if that business was legitimate.
Exactly. Enron alone accounted for over a quarter of the audit fees for Andersen's entire Houston office. So the local audit partners were incredibly incentivized to keep Enron happy.
So the structural independence of the auditor was completely compromised.
Totally. The sources even note that when Andersen's partner office in Chicago reviewed Enron's accounting and raised serious red flags about those special purpose entities.
The velociraptors.
Right, the velociraptors. The Houston office was actually able to override those concerns. They silenced their own internal critics to protect the revenue stream.
So we have a company booking decades of fake profits on day one, hiding massive losses in dinosaur shell companies backed by their own inflated stock, all while the auditors are being paid millions to look the other way.
That's the summary, yeah.
An illusion requiring that level of constant forward momentum, it's destined to crack. So how does it actually unravel?
The unraveling begins in early 2001. It starts slowly. A prominent short seller named Jim Chanos reads an article about Enron's heavy reliance on mark-to-market accounting.
Okay.
He decides to sit down and actually read their dense financial reports. And he quickly realizes that their reported profits are completely disconnected from their actual cash flow.
They're reporting billions in revenue, but they have no cash.
Exactly. So he starts aggressively shorting the stock. And then the financial media finally wakes up. In March 2001, Bethany McLean, a reporter for Fortune magazine, publishes this article titled, "Is Enron Overpriced?"
The famous article.
Yeah, she dug into the filings and basically pointed out that despite being hailed as a genius company, no one could actually figure out how Enron made its money.
Right, it was just a black box.
And their debt load was skyrocketing. When McLean called Skilling for comment before publishing, he became super defensive and hostile. He called her unethical for not researching properly.
Wow. Deflecting.
Yeah, but critically, he couldn't actually answer her fundamental questions about cash flow.
And that defensive posture perfectly sets up what happened the very next month. April 2001. Enron is holding its standard quarterly earnings call with Wall Street analysts.
Oh, this is the best part.
It's a recorded call. Richard Grubman, a seasoned analyst, gets on the line and complains that Enron is the only major company that refuses to release a balance sheet along with its earnings statements.
Which is a completely standard, reasonable request.
Yeah.
He's essentially asking to see the actual bank statements instead of just listening to Enron boast about their credit limit.
Exactly. And Skilling's response on the recorded line is staggering. He stammers for a second, thanks Grubman for the question, and then audibly calls him an asshole.
Just unbelievable.
The CEO of a $60 billion public company swearing at a financial analyst for asking for a balance sheet, it sent a massive red flag through the entire financial community.
But internally at Enron, the hubris was so deep, employees proudly turned the insult into an inside joke. They literally printed up company T-shirts that said, "Ask why, asshole."
They were actively mocking the analyst. But the math was rapidly catching up to them. By August 2001, Skilling suddenly resigns as CEO.
Yes, citing vague personal reasons after only 6 months on the job.
Very suspicious. And observers quickly note that before leaving, he had quietly unloaded at least $33 million of his own Enron stock.
Yeah, the rats were fleeing the ship. Kenneth Lay steps back into the CDO role to try and project stability. But the panic is setting in. The day after Skilling resigns, an Enron VP named Sharon Watkins writes an anonymous 6-page letter to Lay.
The whistleblower letter.
Yes. She clearly spells out the mathematical danger of the Raptor shell companies and warns him, quote, "I am incredibly nervous that we will implode in a wave of accounting scandals."
And Lay promises an investigation, but he hires the exact same outside law firm that helped approve the shell deals in the first place.
Naturally. And they declare everything perfectly legal. But the market pressure is too immense. The stock price begins a sustained slide.
And that stock drop triggers the death spiral. The Velociraptor shell companies lose the underlying value of the Enron stock. The toxic debt floods back onto Enron's books.
On October 16, 2001, Enron is forced to announce a massive earnings restatement, publicly reducing their shareholder equity by an astonishing $1.2 billion.
The curtain is finally pulled back. The SEC opens an investigation. Fastow gets fired. Enron's credit rating is downgraded to junk status,
which forces them to immediately repay billions in loans they don't have the cash to cover.
A rival company, Denergy, briefly steps in with a buyout offer, but once their accountants actually look at the unvarnished books, they abandon the deal entirely.
Leaving Enron completely isolated. No cash, insurmountable debt, and a stock price that plummeted from $90 a share to literal pennies. On December 2, 2001, they officially file for bankruptcy.
And, you know, for you listening, the human cost of this collapse was just devastating, especially when you contrast the executives with the rank-and-file employees.
Oh, it's heartbreaking.
While Skilling, Lay, and Fastow were cashing out tens of millions in stock as the ship sank, the regular Enron employees were blocked from selling. Management instituted a lockdown on the employee 401k accounts,
claiming it was just a change in plan administrators. But employees had been aggressively encouraged to invest heavily in company stock. 62% of all employee savings were tied up in Enron shares.
They were locked out of their own accounts, watching helplessly as their life savings evaporated down to a few cents. Thousands of people lost their entire retirement nest eggs, while the architects walked away wealthy.
The legal system did eventually catch up with them, though it took years. Fastow took a plea deal, testified against his bosses, and served 10 years.
Skilling got 24 years, right?
Initially, yeah, though it was reduced later. Kenneth Lay was convicted on all counts, but he actually died of a massive heart attack before he could be formally sentenced.
Wow. And what about Arthur Andersen?
They faced a catastrophic reckoning. They were found guilty of obstruction of justice for illegally shredding literal tons of documents right as the SEC investigation was heating up.
Unbelievable.
The Supreme Court did overturn that conviction years later on a technicality, but it didn't matter. The firm's reputation was destroyed, they lost their license, effectively dissolving one of the oldest accounting firms in the world and costing 85,000 global employees their jobs.
Which led to the Sarbanes-Oxley Act of 2002. It fundamentally changed corporate governance. Executives now have to personally sign off on financial reports under threat of prison, and auditing is strictly separated from consulting.
They changed the rules, yeah. But the fundamental lessons of the Enron collapse still echo today. Enron wasn't just the failure of a few greedy executives. It was the total, systemic failure of every single watchdog in the ecosystem.
The board, the auditors, the banks, the media, they all bought into the illusion or looked the other way because the money was just too good. They all saw the rich friend flashing the credit cards, and nobody asked to see a bank statement until it was way too late. And so, given the mind-bending complexity of modern financial markets today, like offshore crypto, algorithmic trading, you really have to ask yourself, are today's watchdogs actually capable of understanding the math behind these modern fortunes? Or is it entirely possible that there is another velociraptor hiding in a balance sheet right now, just waiting for the market to drop?